Hey friends, Ernie here from the Trader of Futures channel, and this video is about treasuries and specifically the yield curve. So I'm laughing because I was just looking at myself and I'm saying, man, am I scruffy? But this is my weekend look. Hopefully the next video I will be a little bit cleaned up here. Anyways, yield curve. You know, Greg has consistently warned us that if we want a clue on what's going on in the economy, to look at bonds and the yield curve. He's pointed out on numerous occasions how the yield curve is flattening, and this might be a sign of a coming recession. So today, I'm going to demonstrate that flattening yield curve so that you can see for yourself how incompetent the Federal Reserve is. So first, the Fed induces or starts our economy down a path towards a recession by themselves flattening the yield curve. And that's absolutely true. I mean, one thing that we can take from past crashes is that the bond market is a huge tell. It almost always starts with the Fed tightening monetary policy by raising interest rates or short-term interest rates and reducing their balance sheet and then engaging in some kind of propaganda campaign that's designed to kind of lull us to sleep. So let's take a look at the yield curve, which plots out the different maturities of Treasury debt. Now, we've learned that virtually all recessions and crashes are preceded by a flattening and eventually inverted yield curve. Check it out. So this is a demonstration of how the Fed actually causes recessions. And they cause recessions by monkeying around with the yield curve. And they do that with their principal weapon, and that is adjusting short-term interest rates. It's kind of like, you know, grabbing a tiger by the tail and whipping it around by the end of its tail. I mean, you're playing with some really nasty stuff here. All right, so on the left-hand side, we have something called the yield curve. Now, the yield curve is all the different maturities of Treasury instruments from short-term to long-term, and that's what you can see at the bottom. It goes from 3 months all the way up to 30 years. The Fed, they control that yield curve to some degree by controlling the short-term overnight lending rate and adjust it, you know, to whatever they say it is. You know, I mean, we remember when Alan Greenspan brought short-term rates way down, and then of course Janet Yellen for this longest time has held rates at near zero, and we're just now starting to inch them up. So the Fed believes that they can control the economy and the health of the economy and the way we're, the economic environment, I guess you could say, as well as employment by controlling this yield curve. But really what's happening here is that they're trying to monkey around with forces that they have no idea what they're doing. And it's been very, very evident that they don't. Because if they did, this phenomenon that I'm going to show you wouldn't be happening. All right. So again, what we're looking at is what's called a very steep yield curve. And it looks very steep because it's going from bottom left to top right. That's the red line. It is plotting the yields for each one of the maturity instruments, the Treasury instruments of different maturities, from short-term maturities at 3 months all the way up to 30 years. And we can see that now we're looking at the yield curve actually right after the dot-com bubble burst. And on the right-hand side, we have a plot for the past 16, 17 years of the S&P index. That's the S&P 500. That's the 500 biggest stocks in the market. And you can see that there's like the blue line is plotting the stock market, and then there's a red line that's showing you at what time or what year that we're in that we're showing the yield curve. All right, and I can move that red line, and as I move it, you can see the yield curve change. Now, here we are in 2003, right after the crash. We hit the bottom. We have a nice steep yield curve, and the Fed is affecting short-term rates by raising them as we're heating up in this economy. They're raising, and you can see on the left, short-term rates starting to rise. And then as we get more and more heated up, they keep on rising, but the long-term rates aren't moving. So what's happening is the yield curve is flattening. In other words, short-term rates are starting to become as expensive as long-term rates until we get to a point way up here, right at the top, where short-term rates at one point become more expensive than long-term rates. And that's called an inverted yield curve. And then after that, that's when we crashed in the great crash of 2008, 2009, and it came all the way down here. Now yields are back down to zero because during that crash, the Fed, in their infinite wisdom, decides that, oh, we gotta lower short-term rates and try to fix the yield curve again. You would think that they would just try to keep the yield curve with short-term rates low and allow long-term rates to fluctuate as they might, or just leave it all alone together. So anyways, here we are in 2009, and they are keeping rates low. They're forcing, as a matter of fact, for a long, long time, from 2009 up until, let's see, right up until 2015, 2016, they've been zero. And we all know that. We've been going through this anemic growth, and that's one of the reasons why we had that anemic growth. Now, let's take a look at long-term rates. They started, up around 4.5%. But with long-term rates kept artificially low, long-term rates started to drop as well. That's because investors were losing confidence in this recovery. When they lose confidence in the recovery, they don't think long-term rates deserve any premium. And they just kept on dropping and dropping and dropping. Now they finally decide to raise short-term rates, but look, long-term rates are not going up. They're basically staying the same. And as you can see, short-term rates are coming up, long-term rates are remaining the same, and if we keep on going at this pace, we're going to get the exact same thing we had over here of a flattened yield curve. And if we go back to before the dot-com bubble burst, we can see that we also had a flat yield curve that preceded that crash. Right? We crashed. And then we had a flattened yield curve that preceded the 2008-2009 crash. It crashed. And now we're going into this new era where we're creating a flattened yield curve. Well, what do you think is going to happen? And let me just tell you that if this chart went all the way back since the Fed's existence, you would see the exact same thing. Every time that the economy is heating up, they want to get their little fingers in there and try to change things and quote, fix the economy, which they have no friggin' idea what they're talking about. And they cause the yield curve to flatten, and then that precedes, all economists know that when you get a flattened yield curve and an inverted yield curve, that's a sure sign that a recession is coming. And then, then the biggest irony of all is that after they've caused a crash by flattening the yield curve, we expect them to then fix it. So they caused the problem, and then we're asking them to fix it. What kind of insanity is that? Tell me, what kind of insanity is that? The Fed is, they are incompetent. There is no other word for it. They think they understand the economy. They know nothing. They never learn from their mistakes. They've caused every recession that we've had for the past, 80 years. How can this keep on going on? How can we possibly have trust in the Fed when all they do is they spurt out, they finally craft their words because they have nothing else to say. Janet Yellen has been saying that they're going to go and adjust interest rates based on the data. But every time the data changes, she does nothing. She's lying. She's lying because they're like deer with their caught in the headlights. They don't know what to do. So they kind of make crap up and make it seem like they know what they do. And then we just bow to them. Man, I don't know what to say. The Fed should be dead.